Hi guys, this is Simon with Trade and Perform Coaching. Going over Friday's session for, let's see, I guess we're November 1st now, and it's Sunday, pretty relaxed. Um, so let's discuss the morning. So, when I go over my trade reviews, sometimes I put things in there that I don't want to release, kind of keep a few secrets for my clients. And then sometimes I have no problem releasing it. I'll be happy to throw some, the general concepts out there to help everybody out. But one of the things that people ask me is, first of all, how do I come up with the zones? So the zones are not layups. I start with volume profile, and learning about volume profile. A good place to start with that would be Mind Over Markets by Dalton. I don't use all of his stuff. I don't subscribe to all of his ideas. But the basic concepts of auction market theory I do subscribe to, and that's a good place to start. However, if volume profile worked in and of itself, meaning it was easy to find the zones or easy to find the areas where we'll reverse by itself, it's just like anything else. It doesn't work on its own. It's somewhat of an artwork to get the zones correct to begin with, and my starting point is with volume profile. So and it's where I would suggest others start with volume profile, but it took me quite a bit of time of working through it and adjusting the zones. After I came up with my volume profile zones, I go back in and I have to adjust them. Sometimes I adjust them through the course of the day. Sometimes I just leave them as they are. Most of the time I leave them as they are. But there's no easy, what do you use to come up with your support and resistance zones? That being said, any book on support and resistance will tell you, how the principles of the market operate. However, taking that concept and moving it over to a package, a formation, a strategy that'll let you withdraw money from the market on a daily basis, on a regular basis, and then not turning around and having to give it back with a trading mistake, that's where a trading coach comes in, whether it's me or any other trading coach. There has to be a solid strategy, and there has to be usually some guidance. This is an incredibly difficult job to do on your own. And I can't stress that enough. Having someone give you feedback on your trading ideas on a consistent basis makes a massive difference. I have someone who gives me feedback, and I certainly give others feedback. So that's something to keep in mind when you are trading, and if you're struggling and trying to figure out, well, why can't I put together multiple days of profits or multiple weeks, or why am I trading 1 month profitably and 1 month losing? And so that's one small piece of the puzzle. In addition, you have to realize markets change, okay? And you have to be able to identify that change. Part of it's just through simple observation, okay? The other part of it is actually having a plan where if things start going south on your trades, you've got to stop and figure out what's going on if you're not catching the subtle changes within the marketplace, right? Because it only takes a week or two to give back 1 or 2 or 3 months of great profits, and it can be extremely frustrating. It can cause you to pull your hair out. And so I think that would be the key focus or the key takeaway of today's trade review is going to be, probably that's the most important thing I've said right there, is the markets change. You have to have a plan to save your account when the markets do change. For example, people who are playing breakouts are getting smoked right now, okay? Whereas had you bought this candle, for example, right here, for the past probably 6 weeks, on the majority of days, you got followed through to the upside. Now all of a sudden you're getting ripped against, right? And it's the same token with the breakdowns, right? When we were breaking down, we just kept going. There was none of this stuff in here. We were getting very little choppiness, and we certainly weren't giving these. Getting these kind of stop, reverse, go back up. It was very much directional, kind of like this move was here the other day, right? Without this reversal move. Right here, it's just straight down, and it continued straight down. That's a momentum trade. In ES in particular, momentum trades tend not to work. Okay, they can really chew up your profits. So keep that in mind. That's all I'm arguing. That's all I'm saying is that the markets change. Have a way to identify that change, and even if you can't identify that change, we actually use two methodologies. I use two methodologies for determining whether there's been a market change and to catch it before it does serious damage. And that's why the guys I've been coaching are able to consistently build those accounts. They've gone very quickly from traders that are losing to traders that are winning on a consistent basis. And it's because we implement kind of a double safe system to identify, plus consistent feedback from me. And it doesn't have to be from me, it can be from another trading partner. But I would suggest you have somebody who can get trading feedback from quickly, right? So that you can catch the subtle changes. So I hammered that enough. Let's talk about the day. So our trade plan called in the morning to stay away from the open, right? Let the market determine where it's going to go. And then we were going to look at the tick and determine whether we were in a trend day up, trend day down, or if we were in a day of balance. And we determined pretty quickly we were not in a trend day. The market pretty much chopped around in a very tight range prior to the data point being released. And really, it was very difficult to make an easy trade in this area because the rotations got very tiny. However, the white zone is an important area on my charts when I do throw it out there, and it has a very high success rate. And it acts as general guidance towards where the market is going to go. The closer we are to the white zone, the more power that it has, right? So if we're coming up from underneath, I would expect, particularly on the first touch, for it to repel the attempted advance, right? And oftentimes it can mark a high or low of the day. The strategy was to wait for a significant rotation, and I had mentioned in the morning that I would not look at 1758 as my entry point, but that I would look for a stretch towards the 1760 area if I were going to take a short. It wasn't a fantastic rotation, but it was good enough that if this zone was going to hold and a tight enough stop, usually most of the traders I coach use a 2 to 3 point stop behind the zone. Okay, so obviously that gave you a nice trade location, and if you were patient and you had some trailers on there, you could get a very nice rotation. Another point, when you're trying to build an account, remember all you need is 1 to 2 points out of a trade consistently to build an account. And instead of focusing on trying to get more trades in, just focus on the trades that you know you can get high odds entry, exit, and you can have those entries, stops, and exits structured. If you can have that, it will reduce your anxiety and it will reduce the amount of thinking you have to do during the day while you're in the trade, and will allow you to move back towards that observer mode so that you can catch the subtle changes in the market. So there was also multiple tick divergences that occurred here. We got a good tick divergence right here at the back of the zone that gave a nice rotation up to the front of the zone. And people often ask, well, how do I know if I'm taking the front of the zone, middle of the zone, back of the zone? And there's two ways to address that, right? The front of the zone is most aggressive. Why is it most aggressive? It requires the largest stop. A trade, ES requires a certain stop based on the rotation size, okay? And generally speaking, the rotation in ES is 4 1/4 points. If you've got to calculate that rotation into your trade execution, okay? So let's assume we were going to get 4 1/4 from the front of the zone, right? Well, that requires, if you're taking the very front, it requires a 2 point stop at the back of the zone to cover 99% of that, right? And if you try to kind of cheat it and use a 2 point stop, all you ended up with was a loss. You never gave yourself an opportunity to make any money with that trade. However, if you took the back of the zone when we experienced some tick divergence, it did give you a rotation for that 2 points. The other reason why I target that 2 points is I know that I have a high odds of getting that and putting it in the bank. I don't have to capture 5 or 10 points. Capturing 5 or 10 points can be hard, even when you know you've got a great trade location. It can require a tremendous amount of patience, and if you have any kind of anxiety or nerves about that trade or fear that it's going to reverse on you, it can make it almost impossible to stay on the trade. However, if you structured your trades in such a manner that it'll allow you to stay in that trade and it's not a decision you have to make, it's already pre-planned, you'll find that your anxiety levels drop tremendously. And so much of this game is more mental than the actual execution or actual trade location. It's the actual ability to stay in the trade. It's the actual ability to repeat the same trade over and over again. And the goal is to get to the point where your trading is boring. So again, I want to point out just one more area here, and that's, I want to insert this here real quick, just on a larger, I use a 1 minute tick divergence generally, but here at the low, right, part of the key is when we enter trades, not only do we want to enter the trade where we can make a profitable trade, but we also want to avoid entering a trade where that entry has a high probability of causing losses, right? So we want to look for good rotations down, right? When the market is stretched, it acts like a rubber band. Stretch, 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 snaps back in. Then it's allowed to stretch back. Now, as you stretch a rubber band more and more, it's going to lose its elasticity. It may not stretch all the way back to where it started from. But you don't want to enter, you want to avoid taking shorts when the market's stretched to the downside, just like you want to avoid taking longs when the market is stretched to the upside, because you reduce the odds of the trade working in your favor just through natural market forces. The other thing, people are always asking, well, what does the tick divergence look like? Well, just a quick example. This is tick divergence right here. Okay, we had lower lows, we had lower highs, and then very quickly the market reversed, came back in for a little test, and then worked its way up from essentially 1747 right at the top of the initial support area. This is an 11-point rotation up. Okay, that's $550 a contract. And if you have a plan for taking advantage of it and you have a way to structure, and you can stay through that structure all the way through. Now, let me tell you, we weren't doing that great the last 5-6 weeks. I wasn't personally. I was making money, but I wasn't. But there was a lot of potential for frustration in there, because I tend to not chase ES to the upside. I need to pull back. I need a rotation up. I need a rotation down, and I need the drives not to be consistent up or consistent down. And in the last 5 weeks, it was difficult. However, they were profitable. Okay, we were squeezing through them, but they were profitable. And once we got through that period and the market came back to what is quote normal, meaning this is the market we had today, this is 80% of the time, right? The last week, what we've had all week has been what the market looks like 80% of the time, right? And that's where I excel. And so I'm not trying to present, when you see things out on the internet, well, we make 100% of the time. There's very few traders who are actually capable of doing that. More likely, the result is we come in, we come out, we come in, we come out, we come in, we come out of periods of making a lot of money and not making so much money. The difference is, and while I'm a little tired, guys, so I'm sorry for the come in, come out part there. The difference is that when I have the market get difficult on me, my trade plan, I can adjust my trade plan quickly, identify it, and even if I'm not making a tremendous amount of money, I'm not giving back all my previous week's profits, right? I've identified, I've slowed down, and I accept that the market's not going to pay me right now a lot, but it's paying me a little, and I'm not giving back any. And then when I get to my market, right, and these are my best markets by far, I'm just nailing them to the cross. I just, am merciless in taking my profits and hitting my entry points and my exit points. And that's how you make money in trading. And you don't need a million markets. You don't need a million trades. You need 1 or 2 good trades a day. Repeat it. And for me, it's all about increasing trade size on my highest odds trades. And that's how I stay consistent and I build my account. So anyways, that's what I got for today, guys. If you need help with trading, feel free to contact me. Even if you don't need coaching, you just need someone with a good trade plan and mine's not working for you, happy to give a reference. There's a lot of good guys on the internet that actually provide real trading plans and real structure. And then there's a lot of BS, as everyone knows. So anyways, have a great day. My name is Simon, Trade and Perform Coaching. You can reach me at tradeandperform@gmail.com, or you can hit me on Twitter or StockTwits. I hope everyone's having a great weekend. See y'all tomorrow.